Welcome back to another Market Insight. Joined by Aaron, just the two of us, first time in a while.
Building castles in the sky.
There we go. You know, we've been doing this a long time. Your feedback to me has always only ever been one thing, which is you're too fact-based, do something different, maybe switch it up. So we're going to start with a couple fun topics right out, and we will get to more of a market update.
One of the castles in the sky that we're building is our Spotify channel. Please go down to the link below, follow and rate that new podcast. We're really excited about it.
These are what's been coming out of the administration. We have three of them. When should companies be reporting? Quarterly versus semi-annual or different? Well, let's just start there. And why don't you kick it off?
Neither. I think they should be reporting all the time and then have to deal with the situation so that the information is far more public and far more timely. I know the idea is to have longer time horizons, but I think analysts and the market can project and look at what the future will be, and we'd have more relevant information on the time, all the time. We have the technology, let's do it.
You mean like a monthly?
No, just run the data all the time.
Okay, interesting. I was not ready for that. I like the semi-annual. I think you allow so there's a difference between constantly giving the data, like you're saying, and giving forecasts for the data. I like the idea of longer forecasting versus trying to hit your quarterly numbers.
Absolutely.
And what I would actually like to see, who knows what's going to happen. This helps smaller companies who a big company can easily put out quarterly reports. A smaller company that doesn't want to do that and wants to forecast longer maybe helps more companies come public too. So you answered kind of the immediate fear, the immediate reaction that people had, which was now we're not going to see financials. There's going to be more issues with reporting. Mm-hmm. And I'd like to see maybe you roll out management every 6 months versus pulling them out every quarter to do the roadshow of how earnings are, and you're still getting the data. So you still do your 10Qs, quarterly earnings, you're forecasting and doing something semi-annual, and you actually might get more data by doing that because you're still getting the financial statements, but then you're getting an intra-quarter look at how the business is doing as they stagger that.
Mine's on the data. Just let that data flow. I think public markets should be the ones that we have the most information on. There are reasons that companies are not going public, one of which is that the amount of information that you can get from a company once it goes public diminishes. So there's so much money in private equity, venture capital, and they get better information. There's more information on non-public companies because of these quarterly requirements. So let's open that up. Now there's other things, IPOs, Sarbanes-Oxley, that raises the cost and why other companies are not going public as well. So there are other reasons, but I think this would be a step in the right direction. Data, not having to give a forecast every quarter.
The line of public companies, just number of total public companies, it's just a line that's going down over time as companies are choosing to stay private. And a bunch of the big ones still in kind of the VC or mid to late stage VC are probably not going to go public. The ones that are associated with Elon Musk, why would he want to go public again?
Right. Especially with the amount of money that's out there privately, right?
And well, that's a good transition. The next topic. Now, the top, we didn't even reference it, was a Truth Social post from Trump comparing the longer time to China. I don't know if that's a good idea to be comparing it to China, and you took the opposite side of that, so that's great. The next is actually an executive order for alternative investments inside of 401k plans. I have pretty strong opinions on this one. It's the idea is obviously to get more access to investments. Now, I started the local CAIA chapter for alternative investments mainly for education to make sure that private wealth, retail, isn't becoming the bag holder for institutions' assets that they couldn't sell. Mm-hmm. So this one is important to me. I'm afraid that could happen. I want to make sure that it's not, and I don't think it's a great idea. When you pull through the two options, so actually we just held a panel on private equity last week with a very small provider, so a provider who could easily become, if this moves through, a menu option in a 401k. You log in, you can buy the S&P 500, buy a target date, or maybe you buy a private fund. That's one way. I think it's an awful idea. It's illiquid. There's no way for the participant to really track that and know. We really want them to be in a liquid investment. And that's what our panelist said. He doesn't see that coming anytime soon. So the headlines that's coming is not necessarily true. The other side was from Apollo. They said they're actively trying to do this. They want to get inside a target date fund. Mm-hmm. And they've chosen State Street. So they have plans to launch a target date series with State Street, who's been an underperforming target date fund. So it's probably, from a business standpoint, from State Street, let's launch a new product that can start performing better. Maybe that's a good idea. And they're going to be 10% of the target date fund, roughly, in the private markets. So when I look at that, it's a little bit different than being a menu option. Most people won't even see it. So that's one of the fears. You have this higher cost private markets. They'll take expense ratios up like quadruple because of how expensive private markets are versus the public market passive. Maybe it helps with the performance, but we like Apollo. So at least from the standpoint of me being fearful that you're going to get underperforming private markets or poor managers, at least you're getting Apollo in that scenario.
I would say that as a libertarian, I'm all for it, but within the guidelines that we already have, right? This is why it's important to be a 338 or have your 401k by 338, is that you have somebody there to educate, to understand. We've had individual stocks in 401k plans for quite some time, but it's typically a company stock that you work for. So there's a lot of education, a lot of information. If you were to just open it up and have all kinds of cryptocurrencies, alternatives, and people are just selecting because they don't have any education, I think that is a recipe for disaster and you'll roll this away. But if you come across it with, hey, we're going to educate, we're going to be very selective, or we're going to put it in a fund of funds where managers are there, that makes a lot of sense to me. We had accredited investors rules for all these things for good reason. But I think that they also went a little too far. Getting people access, especially whenever we're talking about public markets where you have less and less information, we have less and less exposure of different stocks, that this helps get the investor that isn't accredited some access to that. All of that makes sense. Like anything, I don't think the bureaucrats do that well, but people that are pushing a product can often cause a lot of problems as well.
The education part is difficult to get the outreach enough to get your participants to understand. And the 401k industry moves so slow. It's something as we've gotten into it over the last several years, you see, not too long ago, the default option was cash. So most people are not selecting or coming to your education meetings. They're going to whatever you default them in. Now, most of the time, you're defaulting them into a target date fund based on their age, retirement expectations. So now the issue is you're going to default people into 10% private markets who don't understand private markets. And they don't understand that there's illiquidity in that. Now, the rest of the portfolio, 90%, is liquid. So that's the whole idea of getting past that. So it's not necessarily bad. It's just something that I think is going to take some time. The opposite side of that is I absolutely think it's happening. And we've, from our moat strategy where we invest in individual stocks, it's an opportunity for some of these investment managers that we think could get more access, more AUM, higher fees, higher payouts. Something we want to take part in. When I look at it differently, our 338 lineups, I don't see us doing this anytime soon, but from allocating to the trend, I think it makes a lot of sense.
Well, from my understanding, I think that there are ways to get them into the plan under current laws. It's just very few people do it. But I could be wrong on that.
That's true. And the one interesting point on that is the crypto, which you referenced. Hopefully compliance lets us say this, but we use in our plans a really large custodian that is behind a lot of these. It's not that plugs into a lot of the record keepers. Now they actually allow an Ethereum ETF, but they don't allow a Bitcoin ETF. We don't use either of them, but just to show the kind of the weird things that happen behind the scenes, how they've approved Ethereum but not Bitcoin. What I don't understand. I asked them about it as soon as this came out. Like, what is the plans here? And they said they have no plans. So, final fun topic: Fed independence. And this is a good one for you. You've followed this for a long time. I actually, just like the first part, have no idea what your current take is, though.
Arthur Burns says there's no independence. The inflation that was brought on through the Great Society and then Nixon and decoupling from the gold, these are political positions. So sure, there may be some kind of firewalls to try to stop things, but there's no independence there.
So the main issue right now, there's two of them. I don't even know if we want to take on the Lisa Cook stuff, but we can start with Steve Myron, who was the chair of the CAIA, so the top economic advisor to the president. And when a Fed governor steps down, she wanted to go back and teach. Why take the heat? And you can make a lot more money. I get it. She goes back to teach. It's a common thing that they do. Opens up a seat, a governor role, long-term roles, the 14-year roles, and the president chooses Steve Myron. The part I didn't like about it is that there's no long-term plan. Why not take some time, find somebody who you want in the seat for a long time to actually fill the role rather than just filling it for 4 months whatever it is. So Steve Myron takes the role. Now the fun part here, what I looked into, I didn't know this, I didn't follow the most recent hearing for him to, he got through a CEA very easily, figured it would be easy. And that's the reason he hasn't relinquished his CEA spot yet. And that's the issue people are having with him. He doesn't want to sit in front of the Senate for a third time within a year and be reconfirmed when he leaves the Fed in the spring. Do you know how often that CEA role actually then goes on to become a Fed position? It goes exactly with what you said. It's extremely common to go from being an economic advisor to the president to then being their pick for the Fed.
I don't know how often, but I'm sure it does happen often.
I wrote it.
It's like, where do congressmen go? They go to the lobbyists, right? Of course, it's an iron triangle type of situation.
You don't even have to write it down. The names are so memorable, and you already said one. Arthur Burns, Bernanke, Janet Yellen, Austin Goolsbee, and Steve Myron were so far, I don't know, did I say Greenspan? So it's some of the most famous Fed chairs, and Goolsbee didn't become a governor, but Goolsbee was Obama's top pick, and now he's a Fed voter on the FOMC. So some very famous roles that went on to do this. Again, there is nuance of why Myron may be different than that because he is only taking the role for a short period of time. Maybe he'll end up being nominated for the role to take the governor role for 14 years.
All right.
The other fun part about the Fed roles is if you look at the last few governors, so Cook, Jefferson, Myron, Bowman, Waller, so half of that is under Trump, half of that's under Biden, and you just mixed up their resumes, it's all the same thing. You wouldn't be able to tell the difference. So exactly like you said, there is no independence. It's kind of just become a fun talking point that people want to pretend that there is. Let's just hit the Fed meeting yesterday, first rate cut in almost a year, 9 months or so. And let's go through with the couple economic points that they give. So the first one that's always talked about is the dot plot. And I put in quotes that this was a risk management cut. Powell didn't say that. They got him to say that through framing him in a question. And what it is just a forecast of where every member, not just the voters, so you don't necessarily know which dot is who. One exception is pretty obvious. I put Steve Myron's face there, that his view would be cut rates aggressively right now. And it's not, Trump was calling for 1% interest rates. You're not seeing that. He's just saying, I want to cut rates now, and gradually 1 or 2 more cuts over the coming years. So he's taking a lot of flack online for this. It was pretty predictable that he would have this view. Is it more independent to then go in there and take your own view and show it, or would you rather conform and not be such an outlier?
Once again, political appointments, and he was appointed because this is his view.
Yeah, I completely agree with that. So we see rates are coming down. We actually can show that in the next slide too. This is just a comparison of so every 2 meetings they release their projections for rates. You get the dots, you get also expectation for unemployment, and inflation, and GDP. So I put green where there's upgrades. So there's upgrades in GDP. They're expecting it to be higher than they previously thought. They're expecting unemployment to be lower going out the next couple of years. 2 upgrades to inflation, so not a good thing. The other 2 upgrades were good things in 2026, but then they think we'll get back to 27. Their forecasts for this have been awful. Yeah. The market still responds to it, and it's worth looking at. And then the bottom part, their expected rate cuts, they're expecting rates to be lower than they were in June. So overall, pretty much exactly what we expected. There was a lot of market volatility yesterday around it, but ended up closing basically flat. So I think the market was confused at first and then realized, this is right on.
The only thing I would say is I think GDP is probably going to be higher, but so will inflation. We made an early call that we didn't think tariffs would show up as an inflationary component, especially as the money supply was very stable. It has been increasing. If they were to lower the rates, money supply would increase again. You would see a lot of activity. I think GDP goes higher, but I also think inflation goes higher in that scenario.
I think it's a good forecast. For our forecast, we thought we'd see a lower energy price that came through the reports to help balance off some of the tariffs and a little bit of demand destruction elsewhere, which would be decreasing one side while the tariff prices have hit.
Right.
We haven't seen the decline in energy prices. We still think the supply dynamics set up to see that throughout the fall and winter. And we have not seen any demand destruction outside of the tariff-related areas, which has been the inflation has been a little bit higher than our expectation from the reports. But our view is still that tariffs are not inflationary because it doesn't affect the money supply. It can affect a short-term inflation metric.
Inflation is always and everywhere in monetary policy, right? Or monetary phenomena.
So I completely agree with your expectation for GDP and inflation. What does that get us to for interest rates? Because we were talking about mortgage rates yesterday, and often we get asked mortgage rates from the standpoint of people buying a house rather than the standpoint of their fixed income portfolio, the way I take it, where how are we investing with the market and interest rates? What were you thinking about mortgage rates?
Well, I think this is one of the areas for me, especially, I lived and was in the industry during the 2008 collapse. Real estate has always historically been an indicator that we're in rough times, but I think this time is different. That a lot of it is how fast rates went up. I think that is showing in here, and I think these are going to convert. What we're looking at is that the current mortgage rates versus the effective rate on all mortgages, and as these get closer, then we'll start to see a lot more activity in the real estate area for residential, because you're not looking at, well, rates are 7%, I got a 2.5% from COVID, I'm not going to make a change. But as these continue to go down, if we're at 4% next year on mortgage rates, and people are to the point where they need a new house, that differential stops, and we'll start to see a pickup in real estate. So I think this is one of those areas that I think is saying, hey, there's caution on the economy, but I think you can excuse it away whenever you start to look at the details. And I think as interest rates move down, I think they're going to, we're going to start to see movement here.
And the interesting part about mortgages is just the spread is really elevated. So we, from a portfolio standpoint, we are allocated a little more to mortgages than typically we would be. If we look at this chart, this is going back historically. Mortgages are in blue, and green is corporate bonds, high quality bonds with low risk of default. And this is a spread, so it's the rate above a Treasury bond. And the rates usually are the other way around. Yep. Usually you get paid more to take risk in corporate bonds rather than mortgage bonds. There's a lot of reasons for that. Interest rate volatility is one, where people don't like rates come down, you get prepayment, and you don't get the rate you thought you were going to have in a mortgage. So there are reasons for it to be elevated, but it is on the very high end of elevation. So if we're saying rates could tick down, it could be both from Treasury rates coming down a little bit and spreads tightening on the mortgages as well. So they're not at the high end of typically what they are.
High prices solve high prices, right? So you're going to see people reach for yield if this continues to stay, which will then increase the supply of mortgage, which will then bring rates back down.
Simple way of charting this. Now we go back to the Treasuries, not to be confusing, but when we look back the last few years, this range, it's been more behaved than I drew it. It went all the way up to 5 and then 4 tends to be the range. It was really spent a lot of time, if you were to do a line of best fit, right in the middle of that, around 4 or 5. Now we're starting to cut rates. So there are higher spreads between those rates and longer rates, which tend to hold. Now, I think we're just going to see a shift downward in this trend. We're not going to see stable rates on the long end of the yield curve. They're still going to be pinging back and forth with inflation and changes in the economy, but maybe a shift down by 50 basis points from 5 to 4 to 4.5 to down in the 3.5 range, which is this next chart just zooms out further because we had to go back a few years to see where we spent a lot of time here. It's not new. It's just a few years ago this was the range.
I know we were reading the tea leaves of the dot plot, and it's just 12 or more than 12 people giving their projection, but I think this tells us more. Before interest rates were cut yesterday, interest rates were already going down because of the market. So I think that phenomena continues as people are more comfortable, and we're starting to see these rates come down. And then the Treasury obviously is going to be operating in that environment, so that makes sense.
Last month we had Brian on talk about jobs. You and I don't talk about it very often, but let's just look back to some of these revisions. We have a chart going back of showing, we just got revisions last week, about 1 million jobs, 911,000 that didn't exist.
That's a reason not to talk about them that often, right? Because the data is just not very good, or at least trustworthy.
And it didn't change anything. When we look at trying to forecast out the market, just the idea that those jobs weren't there, it didn't change corporate earnings. That didn't have any impact. It changed Fed policy maybe a little bit. Powell kind of ignored it in the press conference yesterday, which same reason we're ignoring it, is saying we'll look at the unemployment rate, the raw number of jobs, maybe doesn't matter. The interesting part on this chart, it's common, we're on the high end of it, no doubt, but the last couple times that jobs actually were revised up was during a really tough market environment, 2022 in 2018, the last two times, market was going down around that time when that was happening. Not that that's the reason, but at least you're saying, well, why aren't we talking about it more? That's one of the main reasons. The important part that we do talk about is initial claims. I don't have necessarily a chart on that, but the initial claims is real data, seasonally adjusted. But every week we get to see how many people are filing their first claim for unemployment. It spiked last week. Sometimes those spikes can be something seasonal or something geographic, and it was a big spike in Texas. Get a new number this morning, back on trend, 230,000 roughly. It's the 250 number where we start to get concerned just historically when it spikes there. And it did spike above that last week, but it doesn't look to be a trend. It looked to be just an outlier.
So we've talked about jobs, we've talked about the real estate, both of which are a little bit cautionary. What is our take on the market?
Yeah, it's a common question, just a really simple question that can be hard just to answer.
Yes.
We found a good chart, just a good overall summary out of Goldman, just going through, well, what's the high level points to look at? Number one was just monetary policy. 9 out of the 10 central banks are starting to cut rates. I think that the 10th is probably Japan. I didn't look at that. So clearly this was actually out before the Fed cut rates yesterday. So household wealth is really strong, 96th percentile. Profitability is extremely high. Same with earnings. The one that gets scary is credit. So a lot of people throw out those charts where credit is just extremely high, growing, and that people are strapped. They rarely, we call it a chart crime. I think Dan did it last time. We actually talked about it last month. If you put it and divide by disposable income, that's the chart on the bottom left, where we were getting concerned over the past couple of years. It was rising, but now we're starting to come down. The same thing was true with delinquency rates. They were certainly rising, going down, but also going back to the same thing we did with jobs. Every time delinquencies were rising, it was no signal. We've tested it before to say delinquencies rise. Is this a sell the market situation? And it didn't. There was no data there to say this is time to sell the market. And this time held the same as delinquencies were going. The market held in fine, and now we're seeing them come down a little bit.
So despite having some cautionary signals, when we look at it, we have monetary policy that's going to be accommodative. We have discretionary income high relative to credit. And we also are having a wealth effect that continues to play. So there's a lot more of a bull argument. I know that everyone feels like the shoe's about to drop, but I think a lot of that is just what we've been going through as rates were high, that we're feeling that, and we've been really working hard, especially with AI, to become more productive. And I think as the interest rates drop, I think there's a better argument on why we can go higher than it is that the shoe is actually going to drop. And
we're not blind to the risk, right? We're taking profits throughout time. So we filled hub accounts a couple months ago. We started taking profits in some of our AI names, just trimming them, just saying they're up 300, 400%. Let's pull some of that out and look for a more broadening position. So we're making moves, moving our feet, or as Dan said, as we're writing the blog to talk about this, everyone needs a haircut, just trimming some of the portfolio.
I think that's prudent. You're following our process and the system because we do know it's not a matter of if we have a recession, it's a matter of when, but there's good reasons to say that's probably further out from here.
A fun one to announce. It's going to be 3 months from now, but we do have Jeremy Siegel, Professor Siegel from Wisdom Tree, is going to join us at the end of the year, working through scheduling, early to announce it, so maybe we don't, but it's going to be a fun one.
So hit subscribe so you don't miss that one, and hit that like button if you do like Jeremy Siegel, and please share it so other people are aware.